On August 15, 1971, the global monetary system changed in a way that was both dramatic and strangely quiet. There were no bank runs in the streets of New York or London the next morning, no immediate collapse of the dollar, no emergency summits of terrified governments. In fact, if someone had been holding us dollars that day, nothing visibly bad happened to them at all. Prices did not double overnight. Salaries were not suddenly worthless. Life went on. And that is precisely why the event mattered far more than it seemed. That evening, President Richard Nixon went on television and announced that the United States would temporarily suspend the convertibility of the dollar into gold. This decision, often referred to as the closing of the gold window, meant that foreign governments could no longer exchange their dollars for us gold at a fixed rate of $35 per ounce. The announcement was framed as a defensive move, designed to protect the dollar from international speculators and to stabilize the global system. It was presented as technical, necessary, and fully within the authority of the U.S. government. Importantly, it was not secret. It was not a hidden confiscation or a backroom manipulation. It was a public declaration made openly, following legal and political procedure. Congress was informed. Allies were notified. The system did not break because of chaos. It changed because the rules were rewritten in plain sight. To understand why this moment mattered, it is necessary to understand what backed the dollar before that night. Under the Bretton Woods system, established in 1944, the US dollar was a central pillar of the global monetary order. Other major currencies were pegged to the dollar, and the dollar itself was pegged to gold. While ordinary citizens could not walk into a bank and demand gold for their cash, foreign governments and central banks could. This was not just a symbolic promise. It was a constraint. It meant that if the United States printed too many dollars relative to its gold reserves, it risked losing gold as other countries exercised their right to convert. This mechanism imposed discipline. Every dollar created carried an implicit cost. It was a claim, however indirect, on a finite physical reserve. The trust placed in the dollar was not blind trust in American political wisdom. It was trust enforced by structure. If the United States behaved irresponsibly, the system had a built-in penalty. By the late 1960s, that penalty was becoming increasingly uncomfortable. The US was financing the Vietnam War, expanding domestic social programs under the Great Society, and running persistent balance of payments deficits. Dollars flowed out of the United States and accumulated in foreign central banks, particularly in Europe. Countries like France began to question whether the US actually had enough gold to back all the dollars it had issued. Charles de Gaulle openly criticized what he called America's exorbitant privilege and started converting French dollar reserves into gold. Others followed more quietly. By 1971, the numbers no longer worked. US gold reserves had fallen sharply from post-war highs, while outstanding dollar liabilities kept growing. If all major holders had demanded gold at once, the system would have collapsed in disorder. Nixon's decision was, in that sense, not irrational. It was a choice between losing control and changing the rules. But what was lost that night was not the dollar's value in a narrow, immediate sense. What was lost was the external constraint that had forced monetary discipline. When Nixon closed the gold window, he removed the last mechanism that automatically punished overissuance. From that moment on, the dollar was no longer anchored to something the U.S. government could not create. It was anchored to confidence in policy itself. This is why the dollar did not collapse. The United States was still the largest economy in the world. Its financial markets were deep and liquid. Its military power was unmatched. International trade was already denominated in dollars, and there was no alternative currency capable of replacing it overnight. Trust did not vanish, because trust had multiple layers. But one layer disappeared completely, the rule-based limit that did not care about political convenience. In the days and weeks after the announcement, markets adjusted, but they did not panic. Exchange rates began to float. The dollar was devalued against gold and other currencies. But the process was gradual. To most observers, this looked like a technical evolution of the system, not a rupture. Even economists often described it as a necessary modernization. freeing monetary policy from an outdated metallic constraint. Yet, this interpretation misses the deeper shift. Before 1971, issuing money involved a trade-off. More dollars meant greater risk of losing gold and credibility. After 1971, issuing money became a policy decision guided by domestic objectives. Employment targets, growth concerns, political pressures, and crisis management all moved to the forefront. The constraint was no longer physical. It was institutional and psychological. This change altered incentives in subtle but profound ways. When limits are external and automatic, discipline is enforced even when leaders would prefer to avoid it. When limits are internal and discretionary, discipline depends on restraint. And restraint is hardest to maintain when the immediate costs of excess are delayed. The most important aspect of this transition is that it did not require bad intentions. Nixon did not need to be reckless or malicious for discipline to weaken. The system itself changed the nature of responsibility. Monetary decisions were no longer bound by an unambiguous rule. They became subject to interpretation, forecasting, and justification. Every increase in money supply could be explained as temporary, necessary, or exceptional. Trust, in other words, was no longer backed by something that could say no. From the outside, the dollar still looked strong. It was accepted everywhere. It remained the unit in which oil was priced and global contracts were written. But internally, the meaning of trust had shifted. It was no longer trust in a promise that could be redeemed regardless of circumstances. It was trust that the institutions managing the currency would choose restraint even when they were not forced to. That night in August 1971 did not destroy confidence. It transformed it. The dollar stopped being backed by a rule and started being backed by judgment. At first, the difference seemed academic. Over time, it would shape everything that followed. And the world would only begin to feel the consequences once it became clear what happens when discipline depends on choice rather than necessity. If the dollar had truly lost the world's trust in August 1971, the consequences would have been immediate and brutal. Currencies that lose credibility do not drift downward politely. They break. Capital flees, contracts are rewritten, and trade seizes up. None of that happened. Instead, the dollar continued to dominate global finance, and for many observers this outcome seemed to validate the decision to abandon gold. If nothing collapsed, then perhaps nothing fundamental had been lost. This conclusion, however, confused survival with health and stability with discipline. The dollar did not collapse because trust in the currency is not a single variable. It is a layered system of incentives, dependencies, and power. Gold convertibility had been one layer, but it was not the only one. By the early 1970s, the United States occupied a position in the global economy that no other country could realistically replace. It produced a large share of global output, controlled the deepest capital markets, and sat at the center of post-war trade and security alliances. For most countries, holding dollars was not an expression of admiration for American policy. It was a practical necessity. This reality shaped the market's response. Even as the dollar was no longer redeemable for gold, global trade still required a common unit of account. International contracts, shipping insurance, commodity pricing, and cross-border lending were already structured around the dollar. Rewriting that infrastructure would have been costly and risky. In the absence of a ready alternative, the dollar retained its role by default. Trust persisted not because the anchor remained, but because the ship had nowhere else to dock. The International Monetary Fund and other institutions reinforced this inertia. Rather than dismantling the system, policymakers reinterpreted it. Fixed exchange rates gave way to managed floating regimes, and volatility was reframed as flexibility. In theory, currencies would now reflect economic fundamentals more accurately. In practice, this shift transferred risk from governments to markets and households while preserving the dollar's central role. The system adapted around the dollar instead of replacing it. Another critical factor was geopolitical power. The early 1970s were not a neutral economic environment. The Cold War structured alliances and trade relationships in ways that limited monetary experimentation. For many as allies, Holding dollars was part of a broader strategic alignment. Even countries that disliked the new arrangement understood that challenging it outright carried political costs. Monetary trust in this context was inseparable from security dependence. The creation of the petrodollar system later, in the decade further, stabilized demand for dollars. After the oil shocks of 1973, major oil-producing countries agreed to price oil in dollars, while surplus revenues were recycled into us financial markets. This arrangement ensured persistent global demand for dollar reserves regardless of gold backing. Energy, the most critical commodity in the global economy, became tied to the US currency. Once again, the dollar did not need moral credibility. It needed structural necessity. From a narrow perspective, this looked like success. The dollar floated, adjusted, and continued to function. But this resilience concealed a deeper shift in incentives. Under the gold-linked system, confidence was fragile but disciplined. The threat of redemption imposed a cost on excess. Under the new system, confidence became robust but permissive, as long as the dollar remained indispensable. Policy errors did not immediately translate into punishment. This is where the real problem emerged. The absence of collapse was interpreted as proof that constraints were unnecessary. If the dollar could survive without gold, then perhaps discipline itself had been overstated. Monetary policy could now be used more aggressively to manage economic outcomes. Recessions could be softened. Political priorities could be funded. Short-term pain could be postponed. The logic was compelling and dangerous. Because the consequences of overexpansion were delayed and diffused globally, they appeared manageable. Inflation, when it arrived, did not point clearly to a single decision or moment. It accumulated. Responsibility became ambiguous. Policymakers learned that they could push boundaries without triggering immediate crisis. Each intervention that did not cause collapse expanded the perceived safe zone for the next one. This dynamic explains why the survival of the dollar was not reassuring, but corrosive. It taught the wrong lesson. Instead of reinforcing the importance of limits, it demonstrated how flexible the system could be. Over time, flexibility replaced restraint as a defining virtue of monetary governance. Central banks were increasingly judged by their ability to respond, not by their ability to refuse. The market participated in this re-education. Investors adjusted their expectations, assuming that severe disruptions would be met with policy support. Risk pricing changed accordingly. The belief that authorities would intervene to stabilize outcomes reduced the perceived cost of leverage. This was not the result of conspiracy or deception. It was a rational response to observed behavior. Each crisis that ended with accommodation rather than punishment reinforced the pattern. It is important to note that none of this required dishonesty. Officials could sincerely believe that they were acting responsibly. The system rewarded intentions as much as outcomes. As long as inflation remained tolerable and growth resumed, the deeper erosion of discipline was easy to ignore. The absence of an external anchor meant there was no clear line between prudence and excess. Policy became an exercise in calibration rather than compliance. This is why the dollar's continued dominance after 1971 was not a sign of enduring trust in the traditional sense. It was trust transformed into reliance. Countries held dollars because they had to, markets priced assets in dollars because everyone else did, and institutions operated in dollars because the system was built that way. Trust no longer reflected confidence in restraint. It reflected confidence that the system would keep functioning, regardless of the underlying imbalances. In this environment, credibility shifted from being rule-based to being performance-based. As long as crises were contained and growth resumed, credibility survived. But performance-based trust is inherently fragile. It depends on continuous intervention and increasingly complex tools. Each success raises expectations for the next response. Each failure threatens not just outcomes, but the legitimacy of discretion itself. The dollar did not fall when it lost its anchor. It floated higher on a tide of necessity, power, and habit. But floating is not the same as being grounded. What appeared to be stability was, in reality, a postponement of reckoning. The system had learned how to operate without immediate consequences, and that lesson would shape every monetary decision that followed. The real cost of 1971 was not paid in that decade alone. It was embedded in a new understanding of money, that it could be expanded, managed, and justified without an automatic boundary. The dollar survived, and because it survived, discipline quietly became optional. When the external anchor disappeared, the system did not immediately spin out of control. Instead, it began to drift, slowly at first, in ways that were easy to rationalize and difficult to reverse. The death of monetary discipline was not marked by a single policy error or dramatic collapse. It unfolded as a sequence of reasonable decisions made in an environment where the old penalties no longer applied. Under the gold-linked regime, discipline was enforced mechanically. If too many dollars were created, gold flowed out. That loss was visible, embarrassing, and finite. It forced a response. After 1971, no such mechanism existed. The constraints on money creation became abstract, forecasts, models, and institutional credibility. These are not meaningless, but they are malleable. They bend under pressure, especially when the pressure is political or social rather than financial. The 1970s provided the first clear evidence of this shift. Inflation surged across the United States and much of the developed world, peaking in the late 1970s. Prices rose not because policymakers intended to destroy purchasing power, but because multiple priorities competed for attention. Governments wanted to fund wars, expand social programs, and avoid recessions. Central banks, lacking independence in many cases, accommodated these goals. Without an external constraint, there was no immediate reason not to. The standard explanation for this period often focuses on oil shocks and supply disruptions. These factors mattered, but they were not sufficient on their own. Inflation became persistent because monetary policy validated it. Wage and price increases were allowed to compound and expectations adjusted accordingly. Once inflation became embedded, reversing it required painful measures. The eventual response under Paul Volcker in the early 1980s, with interest rates pushed to historically high levels, illustrated what discipline looked like in the absence of an anchor. It had to be imposed deliberately, at enormous political and economic cost. This episode revealed a critical asymmetry. Creating money and easing conditions was politically popular and immediately rewarding. Restoring discipline was unpopular and delayed in its benefits. In a system without automatic limits, this asymmetry biases decisions toward expansion. Even well-intentioned policymakers face incentives to postpone restraint, hoping that growth or innovation will resolve imbalances before they become unmanageable. Over time, central banks adapted to this reality by redefining their role. Rather than acting as guardians of a fixed standard, they became managers of economic cycles. Their mandate expanded from preserving the value of money to optimizing employment, growth, and financial stability. Each addition was defensible on its own. Together, they transformed monetary policy into a balancing act where trade-offs were negotiated rather than enforced. Financial markets responded by internalizing this new framework. If authorities were committed to smoothing downturns, then extreme outcomes became less likely. This belief encouraged greater leverage and risk-taking. Credit expanded not only because money was available, but because the perceived downside was limited. When problems emerged, they were increasingly treated as systemic risks requiring intervention rather than as consequences of misallocation requiring correction. The removal of discipline also changed how governments approach debt. Deficits, once constrained by the risk of external settlement or loss of reserves, became tools of policy. Borrowing could be justified as countercyclical, strategic, or necessary for social cohesion. As long as interest rates remained manageable and markets absorbed new issuance, the accumulation of debt appeared sustainable. The absence of immediate consequences reinforced a perception that there was no hard limit. This logic extended beyond the United States. Other countries, operating within a dollar-centric system, adopted similar practices. The global supply of money and credit expanded, mediated through dollar markets and international banking. Because the dollar remained central, the costs of expansion were shared internationally. Inflationary pressures and financial imbalances did not remain confined to the country that generated them. They propagated outward, diffusing responsibility and obscuring causality. One of the most important institutional developments of this era was a growing independence of central banks. On the surface, independence was meant to restore discipline by insulating monetary policy from short-term political pressures. In practice, it changed the form of discretion rather than eliminating it. Independent central banks were still required to justify their actions, but now to markets and models instead of legislatures. Discipline became technocratic rather than mechanical. Technocratic discipline depends on credibility. Credibility, in turn, depends on performance. As long as inflation could be controlled within acceptable bounds and crises could be managed, central banks were trusted. But this trust was conditional. It assumed that tools would always be sufficient and that trade-offs could always be optimized. The possibility that limits might exist, beyond which intervention would fail or backfire, was rarely central to policy design. This mindset gradually normalized exceptions. Each crisis was framed as unique, justifying extraordinary measures. Liquidity facilities, asset purchases, and emergency guarantees were introduced as temporary responses. When the crisis passed, some measures were rolled back, but the institutional memory remained. What had once been unthinkable became part of the toolkit. Discipline eroded not through abandonment, but through accumulation of precedents. The critical transformation, therefore, was not that money became meaningless, but that restraint became optional. The system no longer required discipline to function in the short term. It required confidence in management. As long as markets believed that authorities were capable and willing to intervene, the system held together. But this arrangement inverted the original logic of trust. Instead of trust constraining power, power now sustained trust. This inversion carries a hidden cost. When discipline is external, failure is visible and corrective. When discipline is discretionary, failure is ambiguous and delayed. Mistakes blend into trends. Responsibility disperses across institutions and time. By the time consequences become undeniable, the scale of adjustment required is far greater than it would have been under a stricter regime. By the end of the 20th century, the death of monetary discipline was rarely discussed in explicit terms. It was not perceived as a death at all, but as an evolution. The system appeared more sophisticated, more responsive, and more humane. Yet beneath that sophistication lay a fundamental fragility, a monetary order that depended on continuous judgment rather than unavoidable limits. The world had learned how to live without an anchor. What it had not yet learned was how to live with the consequences of that freedom. By the time the consequences of lost discipline began to surface clearly, the system had already evolved to survive them. This is a paradox that defines modern money. Each weakness exposed by the absence of an anchor was met with a new mechanism designed to stabilize outcomes. Over time, these mechanisms did not restore discipline. They replaced it. From the late 1980s onward, monetary credibility was increasingly measured not by restraint, but by responsiveness. When markets faltered, authorities intervened. When liquidity dried up, facilities were opened. When confidence wavered, guarantees were extended. The expectation that something would be done became as important as the substance of what was done. Trust was no longer anchored in limits. It was anchored in anticipation of support. The architecture of this new trust was built quietly. Central bank swap lines allowed dollars to flow across borders in times of stress, ensuring that the global system would not seize up due to funding shortages. Quantitative easing expanded central bank balance sheets far beyond anything previously imagined, normalizing the idea that money creation could be a primary policy tool rather than a last resort. Regulatory backstops assured markets that key institutions would not be allowed to fail in disorder. Each measure addressed a real vulnerability. Together, they created a system in which continuity depended on intervention. This shift altered the behavior of every participant. Governments learned that deficits could be financed under a wide range of conditions as long as monetary authorities remained accommodative. Financial institutions learned to structure themselves around access to liquidity rather than resilience to loss. Investors learned to price assets based not only on fundamentals, but on the likelihood of policy response. None of this required explicit coordination. It emerged from repeated observation of how the system reacted under pressure. As a result, the question that markets asked about money quietly changed. Instead of asking what the currency was backed by, participants asked who stood behind it. The focus moved from assets to authorities, from structure to discretion. This was not a loss of trust in the conventional sense. It was a redefinition of trust itself. Trust became confidence in management rather than confidence in constraint. This redefinition had profound implications. When trust depends on judgment, it becomes conditional and reflexive. Each intervention raises expectations for the next one. Each success increases a perceived obligation to act again. Over time, the range of acceptable intervention widens, while the tolerance for inaction narrows. Discipline does not vanish overnight. It becomes politically and psychologically harder to exercise. The global financial crisis of 2008 crystallized this reality. Faced with systemic collapse, authorities acted decisively. Banks were rescued, markets were stabilized, and unconventional policies became mainstream. The immediate outcome was widely seen as a success. A depression was avoided, but the precedent was set. From that point on, the idea that major failures would be allowed to fully resolve themselves lost credibility. Stability became an explicit policy goal, even if it required ongoing distortion. The response to the pandemic shock in 2020 extended this logic further. Fiscal and monetary policy merged in practice, if not in law. Money creation financed government spending directly and at unprecedented scale. Once again, the system held. Once again, collapse was avoided. And once again, the absence of immediate disaster reinforced the belief that constraints were negotiable. At this stage, the distinction between trust and necessity blurred almost completely. Countries held dollars not because they believed in a fixed standard, but because the global system was engineered around dollar liquidity. Financial markets relied on central bank balance sheets as implicit stabilizers. Trust persisted, but it was no longer voluntary in the classical sense. It was embedded. This embedded trust is powerful, but fragile in a different way. It does not fail because a promise is broken. It fails when the capacity or willingness to intervene is questioned. The risk is not that money suddenly becomes worthless, but that the system becomes increasingly dependent on ever larger interventions to maintain the same level of confidence. Stability requires motion. Standing still is no longer an option. In such a system, discipline is not absent. It has been displaced. Instead of constraining money creation, it constrains political choice. Leaders are forced to act to preserve confidence, even when action carries long-term costs. The ability to say no, once enforced by gold and settlement rules, now competes with the fear of immediate disruption. The balance consistently tilts toward action. This is a final legacy of the day the dollar stopped being backed by trust in the old sense. The system did not become dishonest or irrational. It became procedural. As long as the right steps are followed, the right facilities activated, and the right signals sent, confidence holds. The discipline that once came from impossibility now comes from expectation. The unresolved question is not whether the system works. It clearly does for now. The question is what happens when trust no longer comes from belief in limits, but from belief in perpetual management. When money no longer needs discipline to function, only coordination. The cost of failure is no longer corrective. It is cumulative. The dollar did not lose its role when it lost its anchor. It gained a different kind of power. But power exercised without unavoidable boundaries changes the meaning of trust itself. And when trust becomes optional, the system no longer asks whether it should expand, only whether it can.